with John Egg here. For the first time ever, gold and silver ETF inflows have overtaken equity fund inflows, not by a small margin, not by a technicality. They crushed them. 33,500 crore rupees flooded into gold and silver ETFs in January alone. Equity funds received 24,029 crore. Let me say that again because I need you to understand the magnitude of what just happened. More money went into gold and silver than into stocks. First time, ever. This is not a blip. This is not a one-day anomaly. This is the beginning of the Great Rotation. And I have the data to prove every word of what I'm about to tell you. Gold ETFs alone pulled in over 24,039 crore in January. Silver ETFs attracted 9,463 crore. Combined, 33,500 crore. Meanwhile, equity funds, the darling of every mainstream financial advisor, every talking head on television, every polished newsletter that tells you to stay the course and keep buying the dip, equity funds got 24,029 crore. That's almost 10,000 crore less than precious metals. In December, equity funds received 28,055 crore, while gold and silver combined received only 15,609 crore. In 1 month, the flows completely reversed. Equity inflows slowed for the second consecutive month, while gold and silver inflows more than doubled. This isn't speculation. This isn't my opinion. This is AMFI data, Association of Mutual Funds in India, official numbers, published for anyone who cares to look. The problem is most people don't look. They listen to whatever the mainstream tells them and never check the actual data. That's what we do differently here. We look at the data, we read the reports, and we tell you what they actually say. Before I go further, let me ask you something. Where are you watching from right now? Drop your country or your city in the comments. I want to see how far this community has spread. I see people from India, from the US, from Canada, from the UK, from Australia, from South Africa, from the Middle East. This community is global and it's growing because people everywhere are waking up to the same reality. The financial system is shifting beneath our feet and the data is screaming it. So drop your location. Let me know where you're watching from. And if you're new here, roughly 3 out of 4 of you watching right now are not subscribed. If this content is helping you see the market more clearly, if it's cutting through the noise and giving you real data instead of polished opinions, hit subscribe. That's how I know the real community is growing. I'm not interested in vanity numbers. I'm interested in people who want the unbiased truth. Now let me show you why this ETF data is the single most important chart you'll see this month. Gold ETF assets under management now stand at 1.81 lakh crore. Silver ETF assets stand at 1.14 lakh crore. Combined, that's nearly 3 lakh crore sitting in precious metals ETFs, and the flows are accelerating, not slowing down. In December, gold and silver combined got 15,609 crore. In January, 30,500 crore. That's a 115% increase in 1 month. Meanwhile, equity flows went from 28,055 crore in December to 24,029 crore in January. Declining for the second straight month. This is what a rotation looks like. Not in theory, not in a textbook, in real time, in actual capital flows. Real money moving from equities into precious metals, and the timing tells you everything. Why is this happening now? Because gold is above $5,000. Let that sink in. Gold is trading above $5,000 and holding, not spiking and crashing, holding, consolidating, building a base. Right now, gold is steady between $5,020 and $5,038. It bounced from the 4,680 low in early February and has been grinding higher. The 50-period moving average is flat near 5,020. The 100-period moving average is around 4,195 and is still supporting the price. The 38.2% Fibonacci level near 4,155 is acting as support. The 61.8% retracement around 5,138 is the next resistance. RSI is just above 50, showing neutral momentum. This is a market that is coiled, it's compressed, it's waiting for a catalyst, and this week we get 3 of them, but I'll get to that in a moment. First, let me connect the dots because none of this is happening in isolation. The AMFI data showing ETF inflows overtaking equities, gold holding above 5,000, silver compressing near 82, China buying gold for 15 consecutive months, the new Fed chair nomination, geopolitical shifts, the first U.S. bank failure of 2026, the Shanghai premium still elevated, paper markets trading multiples of annual production, physical delivery times stretched to 8 to 16 weeks. Every single one of these data points is telling you the same story. Capital is moving, the smart money is rotating, and the mainstream is either ignoring it or actively misleading you about what it means. Now let me talk about what I think is the most underreported story of the year so far. Kevin Warsh has been nominated to replace Jerome Powell as Fed chair starting in May 2026. This is massive, and I don't think enough people understand how much this changes the game. Markets view Warsh as significantly more hawkish than Powell. He prioritizes inflation control and a strong US dollar. This directly challenges the endless rate cut narrative that fueled gold's run from $3,000 to $5,600. When gold hit $5,600 in January, it was pricing in multiple rate cuts, dollar weakness, and continued monetary expansion. Warsh's nomination is the market saying, wait, maybe that narrative was premature. Maybe the Fed won't cut as aggressively as everyone assumed. And that's exactly why gold pulled back from 5,600 to the current 5,000 to 5,038 range. But here's what the mainstream won't tell you. Gold pulled back 10% from its highs, and it's still above $5,000. Silver got smashed 31% in the biggest daily loss on record, and it's still at $82, testing critical trendline resistance. The pullback happened, the correction happened, and precious metals are still at levels that would have seemed impossible just 18 months ago. The narrative shifted from endless cuts to a more hawkish Fed, and gold is still above 5,000. That's not weakness. That's extraordinary structural strength. The floor is rising. Every dip gets bought. Every correction gets absorbed. And the ETF data proves it. 33 to 500 crore in January. Record inflows. Into the teeth of the correction. And let me tell you something about Warsh that nobody else is discussing. Concerns about the Fed's independence have eased since his nomination. The dollar has steadied. But if the Senate confirmation hearings even hint at political influence over interest rate decisions, if there's any suggestion that the White House is directing monetary policy, the safe haven bid comes roaring back. That's not a hypothetical. That's a hair trigger. One wrong sentence in a Senate hearing and gold goes right back to 5,600. The Warsh nomination is being treated as bearish for gold by the mainstream. I'm telling you, it's a loaded spring in both directions. And the risk to the upside is significantly greater than the risk to the downside from here. Now let me talk about China, because this is the story that the mainstream continues to underweight. The People's Bank of China has now purchased gold for 15 consecutive months. 15 months in a row, not stopping, not pausing. 15 months of accumulation. They bought less near the highs, which tells you their buyers are sophisticated, but they didn't stop buying. That distinction matters enormously. Reducing purchases near all-time highs is prudent risk management. It's not a change in strategy. The strategy is clear. De-dollarization. Diversification away from U.S. treasuries into physical gold. And China is not alone. Central banks globally purchased record amounts of gold in 2023, 2024, and 2025. The trend is accelerating. Now here's an interesting timing detail. Chinese New Year runs from February 16 to 23 this year. Traders are expecting reduced liquidity from Asian markets during that period. Less volume means wider spreads. Wider spreads mean more volatility. And more volatility in a market that's already compressed near key technical levels means the next move, when it comes, could be explosive. Whether that explosion is up or down depends on what happens this week with the 3 major U.S. data releases, and that's what I want to break down for you now. This week is enormous. 3 data points that could move everything. First, non-farm payrolls on Wednesday. If the number comes in below 50,000, the market will immediately reprice rate cut expectations. A weak jobs number means the economy is slowing, which means the Fed may need to cut sooner, which means the dollar weakens, which means gold and silver go higher. If the number is strong, it reinforces the narrative that the economy doesn't need rate cuts, which supports the dollar and puts short-term pressure on metals. Third, retail sales. If consumer spending is strong, it supports the soft landing narrative and the dollar. If it's weak, it confirms the slowdown thesis and brings rate cuts back onto the table. The bottom line is this. The data this week will determine whether gold breaks above 5,138 and targets 5,318 or pulls back toward 4,995. Either way, the structural trend is up. The ETF flows confirm it. Central bank buying confirms it. The Shanghai premium confirms it. And every pullback has been bought aggressively. Now let me talk about silver, because this is where it gets really interesting. Silver is trading around $81 to $82, and it's testing a descending trend line that has held since the 118 high. Recent candles have small bodies, with upper wicks near 82 to 83, which tells you sellers are active on rallies. The market is in a corrective phase after the sharp drop to 64. The price is sitting just above support at around 83.90, but below the 50-period moving average at 85.80. and well below the 100-period moving average at 92.25. The Fibonacci levels show the bounce has stalled near the 38.2% retracement of the last drop, which lines up with the trendline resistance. RSI is near 50, showing balanced momentum. Here's what this means in plain language. Silver is at a decision point. If it breaks above 84, it could run toward 92.25, which is the 100-period moving average. That's a 12% move from here. If it fails at this trend line, it could drop back to 75. That's an 8% decline. The risk-reward from a pure technical standpoint is actually favorable to the upside, but technicals are only one part of the picture. The fundamental picture for silver is screaming. Let me give you the numbers again because repetition is how you cut through noise. Annual global mine supply of silver is 800 to 850 million ounces. On January 30th, COMEX traded approximately 1.98 billion ounces of paper silver in a single day, more than twice the entire annual global mine supply in one day. And while this paper fiction was being created and destroyed, physical buyers were waiting 8 to 16 weeks for delivery, while dealers were suspending trading, while Shanghai spot silver was trading at a $37 premium to COMEX, 44% above the paper price. After a 31% crash, the Shanghai premium didn't compress, it widened. Physical silver in China is trading nearly 50% above the paper price in New York after the worst crash in history. That is not a functioning market. That is two completely disconnected pricing systems, and only one of them reflects reality. And here's what I need you to understand about the ETF inflow data in the context of silver specifically. Silver ETFs attracted 9,463 crore in January. That's real money flowing into silver exposure. But ETF silver is still paper silver. It's a claim on metal, not metal in your hand. When ETF inflows surge and physical delivery times extend to 8 to 16 weeks simultaneously, what does that tell you? It tells you demand is overwhelming supply at every level. Paper demand through ETFs, physical demand through dealers, industrial demand through solar and electronics and EVs. Silver is being pulled from every direction, and the mine supply isn't growing fast enough to keep up. Let me ask you something. Are you a long-term stacker or a short-term trader? Drop it in the comments. I want to see the split in this community because it matters for how you interpret everything I'm showing you. If you're a long-term stacker, everything I've shown you today reinforces your thesis. ETF inflows overtaking equities for the first time. Gold holding above 5,000 despite a hawkish Fed chair nomination. China buying for 15 consecutive months. Shanghai premiums at 44%. Physical delivery times extending. This is the macro picture getting stronger, not weaker. A 31% crash in silver and a 10% pullback in gold didn't change a single fundamental. Mine supply didn't increase. Industrial demand didn't decrease. Central banks didn't stop buying. The only thing that changed was the paper price, and even that is already recovering. For you, this pullback is either an opportunity to stack more or a non-event that you watch from a position of strength. Your time horizon is measured in years, not hours. And on a monthly closing basis, we're still up 19%. This volatility is noise. The trend is signal. But if you're a short-term trader, especially one without a plan, without risk management, without discipline, this environment is a liquidation machine. I've said it before and I'll say it again. A 31% daily crash wipes out over-leveraged positions instantly. CME is raising margins on COMEX gold and silver futures after the crash, margin hikes after a crash. Think about what that means. If you survive the crash, now you need to post more capital or get forced out. That creates more selling pressure, more liquidations, more cascading stops. The paper market can stay irrational longer than most traders can stay solvent. If you're trading this on leverage without a defined plan, you're playing a game where the house has the rule book, the data feeds, and 633 short contracts they can close at the exact bottom while you're getting liquidated. That's not a fair fight, and it was never meant to be. Now let me put the full picture together because I want you to see every thread and how they connect. Thread 1, ETF inflows overtake equities for the first time. 33,500 crore into gold and silver versus 24,029 crore into stocks. Capital is rotating. The great rotation from financial assets into hard assets is no longer theoretical. It's happening in real time, in real money, confirmed by official AMFI data. Thread 4. China has bought gold for 15 consecutive months. Central banks globally continue to accumulate. This is not speculative buying. This is strategic reserve building by sovereign nations that see what's coming. When central banks buy gold for 15 months straight, they're not trading a chart pattern. They're preparing for a monetary system transition. Thread 5. The paper versus physical disconnect is widening, not closing. Shanghai premiums at 44% after the worst crash in silver history. Delivery times at 8 to 16 weeks. COMEX trading 1.98 billion ounces in a day against 850 million annual mine supply. JP Morgan closing 633 shorts at the exact bottom. The paper market is a pricing mechanism that has completely detached from the physical reality it's supposed to represent. In every data point, from ETF inflows to delivery notices to Shanghai premiums, confirms the disconnect is growing. Thread 6. This week's U.S. data releases, non-farm payrolls, CPI, and retail sales will determine the short-term direction. But the long-term direction is already determined by threads 1 through 5. Whether gold goes to 4,995 or 5,318 this week doesn't change the structural thesis. Capital is rotating into precious metals. Central banks are accumulating. Physical supply is tight. Paper markets are losing credibility. And for the first time in history, more money is flowing into gold and silver ETFs than into equities. Now I need to address the geopolitical picture because it matters more than most people think. The Middle East situation is evolving. Talks between the US and Iran and Oman are being described as productive. The market is interpreting this as de-escalation, which reduces the geopolitical risk premium in gold. Fine. But let me ask you this. How many times in the last 30 years have Middle East peace talks been described as productive only for the situation to deteriorate 6 months later? The geopolitical risk premium can compress in the short term, but the structural risks haven't disappeared. Iran's nuclear program hasn't been resolved. Regional tensions haven't been settled. A temporary thaw in diplomatic language is not the same as a permanent resolution of fundamental conflicts. So yes, the short-term safe haven bid may soften, but the medium-term geopolitical floor under gold remains firmly in place. And then there's Japan. Prime Minister Sanae Takaichi's landslide victory on February 8th has introduced Sanaeonomics, which means increased fiscal spending and higher military budgets. In the short term, this is risk on. The Nikkei is rallying, Japanese investors are moving into equities. This reduces short-term demand for gold from Japanese buyers. But look at the second-order effects. Increased government spending means increased government debt. Japan already has the highest debt to GDP ratio in the developed world. More spending means more borrowing, means more money printing, means more currency debasement. And what's the ultimate hedge against currency debasement? Gold. So Sanaeonomics is bearish for gold this week and bullish for gold this year. The mainstream gives you the headline, we give you the full analysis. And the key question nobody is asking is this. If gold and silver ETF inflows are overtaking equity inflows for the first time ever, what happens when the equity market actually corrects? Right now, equity markets are near historic peaks. The ETF rotation is happening while stocks are near all-time highs. Imagine what happens when stocks actually drop 15 or 20%. Where does that capital go? If investors are already choosing gold and silver over equities when stocks are at all-time highs, what happens when stocks fall? The answer is obvious. The rotation accelerates. The 3,500 crore in January becomes 50,000 crore, then 75,000 crore, then more. Because when the equity bubble deflates, and every bubble eventually deflates, the capital doesn't disappear. It moves. And the AMFI data is showing you exactly where it's moving. Into gold, into silver, into hard assets that can't be printed, diluted, or defaulted on. The markets are currently pricing in 1 to 2 additional rate cuts by the end of the year. If those cuts materialize, the dollar weakens and gold goes higher. If they don't materialize because Warsh takes a harder line, the economy slows without monetary support. And gold goes higher because of recession fears. If inflation comes in hot because of tariffs, we get stagflation. And gold goes higher because it's the only asset that performs in stagflationary environments. If inflation comes in cool, the Fed cuts and gold goes higher on dollar weakness. I want you to read that paragraph again. Every scenario leads to the same destination. The paths are different, but the endpoint is the same. Higher gold, higher silver, more capital rotation out of paper financial assets into hard money. And before we wrap up, let me be clear about something. I don't sell signals, I don't sell courses, I don't sell mentorship. I'm not here to give you a buy signal or a sell signal. I'm here to show you the data, explain what it means, and let you make your own decisions with your own brain. The real ones in this community know this. I've never taken one side. I've given you the bullish case and the bearish case in every single video. I've warned about the risks of over-leveraging. I've warned about the risks of short-term trading without a plan. Go back and watch the previous videos. Everything I'm showing you today builds on what we've been discussing for months. And be aware that there are fake accounts out there using similar names, repackaging this analysis, giving you fake numbers and fake stories. I am not responsible for any of that. Verify the channel name with John AG. That's the only source. If it doesn't say with John AG, it's not me. Don't trust it, don't follow it, do your own verification. So let me give you the 3 key takeaways and we're done. Number 1, gold and silver ETF inflows overtook equity fund inflows for the first time in history. 33,500 crore into precious metals versus 24,029 crore into equities. This is confirmed AMFI data. This is not opinion. This is the great rotation happening in real time. Capital is leaving paper financial assets and moving into hard money, and it's accelerating. December gold and silver ETF inflows were 15,609 crore. January was 30,500 crore. That's a 115% increase month over month, while equity flows declined for the second straight month. Number 2, gold is holding above $5,000, despite a hawkish Fed chair nominee, geopolitical de-escalation, and risk on sentiment. Every factor that should be pushing gold lower is present, and gold is still above 5,000. Silver is compressing at a critical trend line near 82 with balanced momentum and a favorable risk-reward setup to the upside. China has bought gold for 15 consecutive months. Shanghai premiums are at 44% over COMEX. Physical delivery times remain 8 to 16 weeks. The fundamental case has never been stronger, and the ETF inflows prove the market agrees. Number 3. This week's U.S. data, non-farm payrolls, CPI, and retail sales will determine the short-term direction, but not the long-term trend. The long-term trend is set by capital flows, central bank accumulation, physical supply deficits, and the growing disconnect between paper and physical markets. Whether gold touches 4,995 or 5,318 this week changes nothing about the structural reality. More money is flowing into gold and silver than into stocks. For the first time, ever. That's the signal. Everything else is noise. The unresolved tension is this. We're watching the largest capital rotation into precious metals in history unfold in real time. ETF inflows have overtaken equities. Central banks are accumulating. Physical supply is tightening. But the paper market still controls the price. The question is how much longer the paper tail wags the physical dog. The Shanghai premium says the disconnect is already at 44%. The delivery times say physical supply is already stressed. The ETF data says investors are already voting with their money. At some point, the paper market will be forced to reconcile with physical reality. And when it does, the repricing will be unlike anything we've seen. The only question is when. And with non-farm payrolls, CPI, and retail sales all hitting this week, with Chinese New Year reducing Asian liquidity, with CME hiking margins, and with the Warsh confirmation hearings on the horizon, the catalysts are stacking up. 30,500 crore. First time ever. Gold above 5,000. Silver at the trend line. China buying 15 months straight. Shanghai premium 44%. And more money flowing into precious metals than stocks. This is the data. This is the proof. The great rotation is not coming. It's here. Invest with logic, not hype. With John Ag out.